Welcome back, Peter Goodburn. How are you, my trading warrior brother?
Dale, can you hear me?
Waiting to hear you. Got you,
Hey,
Peter. How are you?
great to be with you. Thanks, Dale. And yeah, greetings to Blake and Steve. Hi, guys.
Hey, Peter.
How you doing?
Hey, Peter.
Good.
All right, Peter. So you want to share your screen? Green button.
Yeah,
on
let's
Zoom.
try it. Let's try it.
And some interesting red action that we have going on here today. So my question to you is, and you and I kind of keep in touch. I respect your work a lot, Peter, and I'm wondering if last week's reversal, where I had a 2-week reversal where I just used the close from the prior 2 weeks, and if we close underneath it, it's a 2-week reversal. Was that enough for a reversal signature? What we saw last week, considering this week's today's sell-off?
Well, I think so. First of all, I'd just like to confirm: can you see my S&P chart? Okay, I'm on the right screen. Okay, good. No, I think you're right. I mean, maybe we come to the same conclusion from a different angle, but from an Elliott perspective, this morning's break below the previous week's low, I think it's really important because up until that point, last week, the rally from this 42.79.80 area, which I'm pointing to at the moment, up to the highs.
Right.
Last week was an intraday 5-wave pattern. Could have been the first wave of the fifth. It could have been the fifth in its completion. We wouldn't know until, of course, this morning we've broken below last week's lows, and that means that the fifth wave is pretty much intact and finishing, and that we're getting confirmation.
So it was kind of what. I mean, it wasn't a what they call it wasn't exactly a fifth wave failure because it made a new high. Would you call that a truncated fifth, or how would you label that last rally? Just a 5?
Yeah,
right?
it's no truncation. You get a truncation if the fifth wave doesn't break above the third. The third wave's here,
I see.
and the fifth wave is up here.
Okay.
So this looks okay. So we've got, there's 2 ways. There's actually a couple of ways to count this final leg up from 40.29. You can either do it the way I've drawn it here, 1, 2, 3 for tiny fifth wave, or you can go to a diagonal and look at a rather extended fifth. In this case, this was the original targets that we had at 43.67, and basis this one, it could have squeezed up a bit higher, but it hasn't. So it's fallen in between a bit, and it's breaking this residual low. But that residual low here, last week's low, at 42.79 and a little bit, means that having broken that this morning, this is really decidedly bearish. So we've got to start putting on some shorts, because I think that there's no chance for this to go back any higher anymore.
Okay. All right. So after reading your recent views on the market, and I must say that you were early on the inflation reflation trade. Remember, you talked about one more break in copper and then a big move, and and everything soared, base metals, precious metals, everything. And now you're seeing that, like everything else, nothing goes straight up or down forever without digesting gains, consolidating gains. And I think what you're looking for now with the S&Ps is very dramatic and will most likely have impact on commodities as well. So there's Peter's, this is your longer term count, which, I have to say is the most bearish I've ever seen you. And I've been talking to you for over 5 years.
Yeah, I think the context here is very important, because even during last year's sell-off, during the pandemic sell-off, let's have a look at that. Here it is here. I mean, that was a hell of a drop. I mean, if I just scroll back a bit, this is an expanding flat pattern that actually goes back to the beginning of 2018, which is
okay.
So you can see that was a pretty, here we go, back to 2018. We had wave, 3 waves down for wave A, B up and C down. And this was, I mean, this is really huge. But we're talking about an even bigger decline here now. And ordinarily that wouldn't be, I would have said at the beginning of last year when we started to signal that the markets were trending up again. that wouldn't have been an obvious aspect, because the fifth wave from last year's pandemic low, we've got a target at 5,400. Normally, you'd expect that move up to be very similar to the first wave as an expanding impulse. And when I say an expanding impulse, what I mean by that is that you get a conventional 5-wave pattern with no overlap. One of the waves is going to extend, and that's normally the third wave, which is about 80 to 85% of the time correct. So the third wave is dimensionally a lot bigger than the first or the fifth waves. And you can see that here in the third wave of intermediate degree. We begin from this point here, back in 2011. We go all the way up to the 2018 high. And that's dimensionally a lot bigger than the first wave. And if our final forecast for the fifth, it's going to be, a lot bigger than the fifth wave as well. But if you look at the subdivision in the waves 1 and 3, these are expanding impulse waves. They both contain the third wave, which is extended. But here, we've got a very different makeup into the final stage of the secular bull uptrend. Because last year's advance has been so exponentially rising, but it's done so in 3 price swings. In other words, it's subdivided into 3 price swings. And that's not how the first wave of intermediate degree unfolded, neither the third wave. They all started subdividing into 5s. This one's 3s. And the only time that you ever consider a 3 price swing event like this is if it's a diagonal. So you have 2 types of impulse waves, an expanding impulse, this one, or you can actually have a diagonal impulse, which has still 5 waves, but you get lots of overlap. And the makeup of that is very interesting, because the second wave demands a very steep sell-off, a correction to the first wave. And normally the second wave is about sometimes 61.8%. I've often defaulted more recurrence at 76% retracement. And that's how we come up with this very, very deep sell-off for a diagonal second wave before it starts to build up again later. So it means a big shock. I mean, don't forget that this movement up from pandemic lows has set really big records. I think this is the 3rd biggest trajectory advance from a major low in 100 years.
Yeah, really was magnificent. I was selling rallies all the way up. So,
yeah.
Peter, let me ask you this. I know, a lot of people were looking for the dollar to get a bid during risk off, but what's interesting is the dollar started advancing before we got this break in S&Ps. And your target in S&Ps, just in my imagination, I know you're looking for a higher dollar up to, there we go. It doesn't seem like it would be enough of a dollar rally to justify 2,500 in the S&Ps. So do you think that there's going to be a time frame where the S&Ps could continue to go down after this dollar rally completes? Because we're only about 4 points away from that target into November. Or it just isn't going to take as much of dollar strength to generate that type of sell-off in the S&Ps.
Well,
Do you know what I'm trying to reconcile?
Well, don't worry. I've had 3 conversations with institutional clients this morning on the same subject.
Okay.
So you're in good keeping with them as well, because they've said the same. Hey, look, if we're looking at such a big sell-off in equities, shouldn't the dollar be a lot higher than 96 figure? Well, ordinarily it makes perfect sense to think that. I think we have to take it in stages. Quite often the dollar does surprise. I mean, one of the big things which I had a discussion with a major client who's running a $3 billion currency fund was back here. Well, actually, it was back here pre primary wave 2's high at 103.82. If we scroll back a little bit, this consolidation pattern was quite big relative to the preceding upswing. And this particular client said to me, "Hey, Peter, shouldn't the dollar go a lot higher after such a broad consolidation over over 12 months? Shouldn't this really be breaking a lot higher? You've only got a target at 103.72." And shouldn't it, once it breaks out of this consolidation pattern, shouldn't it go a lot higher? And I said, well, no, basis the fib price ratio measurements on the weeklies, it shouldn't do. And he said, so we had a big issue about that. And I'm going to show you now what resolved it, because if we go to a longer term chart, here's the dollar going back to pre-financial crisis lows. And the reason I said 103.77 was my target.
Back.
And if we just extend this original move up like this by 61.8, this is how you project the final conclusion of that correction. Okay, so we had the target at 103, and this is the breakout area here. So strange things can happen. I mean, you'd expect a consolidation pattern like that, maybe to get a lot higher. It didn't. These fib price ratios were very exact. So when we come back to look at the shorter term picture, I'm rather trusting in these fib price ratios, and then tweak it as necessary, because conceptually you're right. If the dollar, if the S&P collapses, you think the dollar should do more than 96. But there's the numbers again, and I think we have to pay attention to that first and see what develops.
That's going to be a battleground for sure.
Yes, it will. I mean, don't forget also, I've labeled this move up as a double zigzag. So you've got the first zigzag here, and I've extended that by 61.8. It's not impossible. It could extend into a triple zigzag. If somewhere during the decline in the S&P over the next several months, we get a corrective upswing, which is, going to happen at some point, the dollar index might drop down in the next wave like this, and we'll get a third and final zigzag coming up to 100 figure or something like that. It's not impossible. Okay. We don't have a crystal ball, but we can manage that pretty well, I think, along the way.
Okay. Also, along with this scenario, and I know you're an elitician, but it seems like it was really all one market since COVID. Everything went up together with the dollar going down, and now it seems like with this bear market rally in the dollar, everything's going down. It's different magnitudes and degrees, but I think showing our audience today what you think could happen to certain commodity markets might save them some heartache. And you're not saying inflation's over. You're just saying that we're entering a pause in the inflation pop, and that there could be some pretty deep corrections in the commodity markets as well.
Yeah, absolutely. I mean, one of the things which have caught the imagination of inflationary pressures is I'm just going to show an extract of our mid-year report, and this is the inflation pop and where we are with the comparative. This is the latest PCI, which of course is one of the Fed's proxies for understanding what inflation pressures are like, and we've gone exponential here. I mean, at the beginning of the year, back in April, we were still sort of quite low, but we did expect this sort of swing up, and it's just gone exponential. I think we're going to raise this target. Here's the latest PCI reading, and 3.4%. So it's gone basically well above what the Fed had predicted basically at the end of last year. They've had to revise their numbers, of course, recently. And here we've got some real yields. But the real yield is an interesting picture because that's actually ticking down now.
Right.
We actually ticked up at the beginning of the year. That's what caught everybody's imagination. They said, well, real yield's actually moving up now. That's inflationary. This thing is going to go berserk. But actually, we've had a pause. And I tend to think that when we take a look at some of the food prices, which are a big impact in the world for inflationary pressures, that's where everybody's going to feel it. We can see that the oils have done, extraordinarily, they've gone really exponential. Some of the oils in the food product area, and the only thing that's dragging behind is meat, but everything else is pretty high. And this is the food and agriculture index itself, which is from the United Nations body, and you can see how it's ticking up. We've got this target at 194. So this is going to be a big push up in the next few years. So inflation pressures are still going to be with us, but we're going to be taking a little bit of a pause. And we can see that here in the DB Agricultural Fund. This is an ETF. So the
Yes.
upswing that we've seen since last year is probably ready to take a bit of a pause. I wasn't certain when I updated this if we get a little bit of an uptick first and then a drop, or whether it drops immediately, because I noticed that in the very intraday picture, there's a little bit of a zigzag decline down here. But anyway, these charts are in our part 2 mid-year report. Actually, I can show you details later if anybody's interested in taking a video of this. But this is just an extract. But I think that we are going to take a pause. Base metals, things like copper prices, which of course are, very, very much in the front end of our commodity research, and certainly in the markets as well, is taking a bit of a pause. So if we take a look at copper prices at the moment, if I can find the right one. Yeah, this is it. And you can see that we're in a regression point. Copper's had a very, very strong exponential rise since last year's pandemic low. And this is LME 3 months, by the way, and I use it rather than COMEX because there's no gaps for the futures market. This is a seamless 3 months deferred spot contract, if you like. So there's no gaps. Anyway, the main thing is that it's dropping down and we should have a good retracement. Somewhat limited retracement in a way. I was actually originally thinking that we might come a lot more, but if we take a look at the weekly chart on copper, you'll see that we're somewhat limited in what we can drop, because here's the first wave. This is the advance in 2016. So we can't overlap with that. If it does, then we may have to come up with a diagonal, which is a bit like the S&P's picture from the last phase. So like this, if it's a diagonal, you can actually bring this down a bit lower, not a huge amount lower.
Well, it's still 30% from the highs here, right?
Yeah, it's still a lot, but it's nothing quite as comparative to the S&P drop that I'm expecting.
Yeah, S&Ps look like they're going to have the biggest drop, but aren't there other base metals? And I'm sure our audience want to know what you're thinking in the precious metals as well during this time frame.
Well, I think gold, we've been bearish for gold and silver since last year, and the cycles were giving us a bit of a clue that for at least 12-month period, that gold and silver and all the precious metals were basically traping down. Silver's, I think a very big thing. I love trading silver. I think I've always been active in silver because I started trading this back in the late 70s, during the bunker hunt time. Yeah. And I was fascinated by what they were doing and the story behind their manipulations and stuff. So silver's really a big thing for me. I love it. But one of the things which, if we take a look at silver, let's just trip back and show my charts a bit here. Yeah, the thing is that silver is engaged in a triangle pattern. And it started last August back here. And we've got it as a descending type triangle. Quite uncommon, these patterns. Here's the bottom in the first drop down here at 2166. Then we come up into that February high, which was all about the Reddit users starting to push up. And then we start dropping down again. And we need to get at or close towards this 2166 area. The measurements that I've used actually come to 2174, which is pretty close. But you can see in the last couple of days, back end of last week and today again, silver's starting to accelerate down pretty hard now. And this is likely to sort of continue down, I think, for another couple of months or more. And that's a good proxy also. If you take a look at the gold-silver ratio and apply that to gold. So gold actually looks like, let's have a look, looks like this, coming down to about 1600. I think we're going to get down here before we start having to buy gold again. I think we're going to break below this March-April lows down here, and we're going to actually break those and get down in a final zigzag pattern from the June high at 1916. So if you're trading gold and silver, I think there's going to be much better opportunities to buy it. And don't forget also that, if you're trading gold and silver, just make sure that you're intraday aware of what the rhythms are moving like in the dollar, because it's pretty much dollar based at the moment. It's dollar driven. Of course, there's sometimes, one of the reasons why gold has driven up from 1750 in the last month is because you've got lower yields in treasury yields, and that's been a factor, a nice headwind. But
hasn't helped it last week and the start of this week, lower yields.
No, I think that's because we've switched more emphasis to the dollar again being
Okay.
strong. But
Fickle
those are
gold
the main
traders.
drivers. You've got to
Yeah.
look for. And by the way, if you take a look at GDX, all of the miners are showing us that we've
Yeah,
got
they were
more.
so much. They didn't respond to bullion strength for a month.
Yes, and basically the don't forget this is the August high last year, so this actually topped out exactly when bullion gold topped out. But these
Right.
corrections, we've still got to get down to these numbers around about 28 on the GDX. I think that would be useful to buy down there somewhere.
Okay. One question I have, classic technical analysis would look at the descending triangle that you're showing in silver
Silver.
as a reversal formation or a topping formation. If we start taking out the 2160 level on a closing basis, would that trigger the formation for being bearish if we took out that support?
Well, I think probably not. No,
Okay.
because let's have a look at
I'm so
something.
old school. But,
No, this is the
go
slightly
ahead.
bigger picture. Well, I
Yeah.
mean,
All right.
no, I mean, okay, look, no, I think it's important to differentiate between certain key points of support and resistance, whether they break and whether they mean something or not. I mean,
Okay.
okay, a level today on the S&P has been broken from last week's lows. That to me is
Right.
very important, but only from the perspective of the preceding pattern.
Okay.
Just because you're breaking a support or resistance level doesn't mean you need. Look, I mean, would you have bought silver on a break above 29.86 just because it's horizontal support resistance? No, you
Yeah.
wouldn't do,
Some
because,
did. Yeah.
well, I'm sure some did, yeah.
Yeah.
But
Breakout.
but
Yeah.
but I wouldn't do it. Why? Because the preceding pattern indicated that this was a corrective double zigzag. So you wouldn't be buying on a breakout. You see some double zigzags or single zigzags that lead to a result in a breakout like this are B waves of more broader patterns like a triangle or an expanding flat pattern. But you've got to know where you've come from and what broader pattern that potentially is in, whether you
Okay.
need to break it, buy on the breakout or not. So you've got to do a bit of homework on your Elliott to understand that whether to buy a breakout or not. Today's breakdown on the S&P is giving us the sell signal, but it wasn't invertly like this on silver. If
I
we
see.
broke down below 2166, would that be a sell signal? No, it wouldn't,
Okay.
because a triangle can allow wave C to sometimes break out of the trading range slightly, as
Yeah.
long as it doesn't collapse. I mean,
Yeah.
so you'd have to look at the pattern and measure up and say, well, okay, we can allow a little bit more. For example, if we were to go slightly lower, what I would do would be to extend this by 61.8, and if it dried up around 2057, 2060, and the pattern looked okay, you might allow
Okay.
that to
Thank you,
still
buddy.
maintain the uptrend. Yeah.
Getting a couple requests that we could wrap it on your view of WTI, which had another tremendous rally. People were scarred by seeing it go negative last spring and a year ago last spring. And, I think that even you, although looking for highs in this market, it was a beast that kept grinding out new ones. And looks like we may finally have something here, right?
Well, I think so. I mean, the assumption was that even though it was grinding up, I mean, this is an incredible move up from 57 and a quarter to this recent high,
Yeah.
just below 77. And I've got this docked as a 3 price swing event, so it becomes wave B of an expanding flat. But I actually, rolling the clock back to March when we got here, I thought that was already hitting top at the time. I thought that the market was already starting a correction in wave X with $39 being put in.
Okay.
And it dropped down here and then broke the highs. And ever since then, we've been adopting this idea that maybe this is a zigzag, which it seems to be adhering to now. But the idea was that if stock markets start to turn down in a big way, which they seem to be confirming today, then oil would follow. And that seems to be
Oil led it.
also consistent.
Oil peaked first, right?
It did to some
Except for
extent.
the Russell. Um, Russell was the earliest peak of anything, I think. But oil put in a secondary high last week, a lower high. So while the S&Ps were putting in their high.
Well, that's what's been difficult this year, certainly from my Elliott perspective. You know, we had the Nikkei 225 index in Japan top out in February. We had the Russell top out in March.
Right.
You know, and so you had immediately sort of bearish divergences. But look how long we had to wait for the S&P to top out. We've, you know, only had confirmation really today, and it topped out basis last week's high. So, you know, you have to.
And it took the Dow till last week to take out its March high.
That's right. That's right. And don't forget the dollar index bottomed in January. And I was getting already excited in January saying, well, if the dollar's bottomed, you know, the stock markets won't be too far behind. But that, you know, that we've had all these major divergences, and that's been very tricky this year, I have to say.
Yeah.
But finally, this is coming to resolve. So I think crude oil is on its way down. I think we're going to get down to $39-40, somewhere down there. So hopefully.
Well, great presentation, Peter.
Thanks.
Okay, if you want to throw up for the crypto people, your Bitcoin chart.
Actually, yeah. I mean, let's take a quick peek and see how that's doing.
And then I want you to show your website so people know how to follow you.
Great, thanks a lot. Yeah, that would be good. Well, cryptos, yeah. Well, we had a great call earlier this year. We did pick out the top pretty well because we had seen initially some declines down here in March, but we picked up the double zigzag up here, and we said, right, that's really bearish. Now I can see that we're starting to break below this 30,000. Well, it's not quite broken yet. 30,500. Let's have a look at it here. This is really, really critical. 30,549. If we break that, and you imagine it might be possible because the only reason Bitcoin is coming off is, it's all about the risk off. Then we're going to have to start looking at the final downside push with this diagonal coming back from this May high down to 26,378. So be aware that if we do take that line out, which it does look likely now, doesn't it? That we're going to end up at 26,378. We're going to have to sort of come down to these numbers, I think, before we start heading up in a bigger way. There was, sometimes, it's difficult if, because Bitcoin, what fundamentals do you follow? You can't. I mean, there's very little fundamental news flow. The institutions are playing this game now, but they have very little information news. So they're all trading the tech side and the technology, the technical analysis side. There's no, you don't know whether or not there's going to be positive correlation with stock markets, risk on and risk off. We've seen it diverge during this phase at one point, and then we had the collapse, of course, which was definitely divergent to the S&P, for example.
China banning it, that's a fundamental.
Yeah. I mean, that was a good piece of information news. But there's not day-to-day news flows like that coming out, like you would trade FX or, stock markets. So it gets a bit tricky. So I can understand why you've got to sharpen your pencil a little bit and do your work on your analysis. From an Elliott perspective, though, if we start to break that secondary low here, I think we'll come down to 26.30. So you're going to have to come out. If you're long, you're going to have to come out and you're going to have to sit tight and wait. I think there's great opportunities going forward, though. I don't think that we're in any bear market at all. I think cryptos has got a pretty bright future, and some of our long-term or longer-term stuff looks a bit like this. We're going way up. So if you want to see some of our work and a little bit more detail, then you can tap into some of our reports. For example, wavetrack.com is our main hub, and you can go here and we have some information. We just published our mid-year reports for stock indices and commodities, and they're very low-end spec price points. So I think about $48, and some of the videos are lasting up to 2.5 hours. And they've got tons of information because you can actually download the PDF reports with all the charts in. So they're great. Or if you want some shorter-term updates, go into our main page and look under subscriptions. So if you click on the subscription tab, and you can see the Elliott Wave Compass report we publish twice a week, and that's $39 a month. And you'll find all our latest Bitcoin, dollar, and stock indices in there, plus a bit of gold and silver and crude oil, of course, as well.
Thank you so much, Peter, for coming over the years and giving us your time, your most valuable currency. I appreciate it very much, my trading warrior brother.
Great.
And
Thanks,
someone's
Andy.
saying Peter is definitely one of the higher caliber guests you have on DP. Great read on the market.
Well, that's great.
Okay.
Thanks a lot
Yeah.
for that feedback.
You
That's
know, and
always
I
nice
saw
to
a
know.
tweet. I saw a tweet where, you know, it's not just your forecasts. Some guy tweeted that they've learned and you've helped them develop as Elliotticians with explaining your work. So
Great.
that's even
Great.
better. So
That's good for me to know, yeah, because
yeah,
I'm very much in the tutorial mode, so I'd like to make sure that everybody's learning something. You know, that's how we progress ourselves. Take self-responsibility with your trading, always, but always to do your homework well and get as much good advice as you can, and then you've got a good chance that you're going to be there consistently at the end. Great stuff.
thank you, my trading warrior brother. Have a great
Thanks.
week, Peter.
Thanks, Dale. Thanks to everybody. Thanks for the boys as well. Good
All
luck with
right.
everything, and we'll speak soon, hopefully.
Yeah, we will. All right.
Good.
So that's a wrap, everyone. You know how to find Peter at wavetrack.com. And we'll see everyone for Turnaround Tuesday. So don't just count your Elliott waves, count your blessings, and we'll see you all tomorrow. Thanks again, Peter. Adios.
Adios, man. Take care.